I just think it's so important for Canadians to realize, and I've had other conversations with guests about this, that, our biggest resource for revenue to support all of the things that we love here in Canada, education, healthcare system, you name it. That's what we're trying to do. But you do need the revenue, and it does come from the commodity sector. So, I hope people start to understand that in greater detail and in greater depth. So thank you for your comments on that. Putting this all together, though, I want to get your take for our viewers in terms of how you would play the energy sector in 2023. Where do you want to invest?
Yeah. So I think broad strokes, you want to still remain in Canada. Our stocks remain mispriced. There are concerns about TMX and takeaway capacity. We've got the differentials for Canadian oil blown out. I think those are going to be rectified over the next several months and quarters. But I want to stay in Canada. I want to stay in oil over natural gas, oil over services. And I want to be in the mid guys, the mid caps, because that's where we're seeing this inflection point where they've achieved their leverage targets and they have promised to the world that they will be returning anywhere from 50 to 100% of their free cash flow next year. And so when we look at that, well, what does that mean? At $80 oil, if I look at the average holding in my fund, my average holding at an oil price, basically where we trade today, is at a 19% free cash flow yield. So 3/4 of that, that's 15%, either in the form of a dividend, share buyback, or some combination thereof. And so why that's important is that next year, that in my mind, that's the catalyst to drive the re-rating, because will a stock stay at a 15% dividend yield if people think it's sustainable? I think not. I think it gets re-rated closer down to 10%. If we go fast forward, dare to dream in $100 oil, which I think we'll see next year, at $100 oil, my average holdings trading at a 30% free cash flow yield. So again, 3/4 of that, you're now in the 20% dividend yield or 20% buyback. So a company able to privatize, in effectively 3.3 years. So that next year is really important. People have been patient this year. They've been waiting and waiting and waiting as companies have been paying down debt. Next year we're there. So when we look at Canadian mid caps, which we think are profoundly mispriced, big weights for us would be Tamarack Valley, Baytex, Headwater, three companies in the Clearwater play, which is the most economic play in North America. These are wells that pay out in months, so it's like phenomenally profitable, and people just don't appreciate that. We want to be in the oil sands. The biggest opportunity, once people realize that we'll be using oil for the rest of our lifetimes, that I can buy into these companies where they're trading at free cash yields of anywhere from 20 to 30%. So a name like a MEG, a Cenovus, where I'm getting decades worth of inventory for free. So that's, to me, a generational opportunity that I think will get re-rated at some point next year. So that's generally where I want to be. I'm avoiding natural gas. I think we're going to be, I've got to call weather in that, but I think if you adjust for normal weather, we're in an oversupplied state next year with production growth in the US. So, gas prices could come off. And services, what we're seeing is most of the fleets are in poor condition, so they require working capital to restore their integrity. So the free cash flow yields that some companies are saying, I just don't believe that I'm going to get that return to me. I think you're going to get capex creep. So in my mind, the surest way where we can extract maximum upside, where I think next year could potentially be a better year than this year, despite energy stocks up 45%, is finally seeing these mid caps return the excess free cash flow. And where I can still buy companies trading less than 2 times their cash flow, that's at 100. At 80, they'd be trading at 3 when they used to trade at 8. So that's the catalyst next year that I see.
Interesting. I would have thought, though, that the services side might have a bit of a bump, just given the fact that you need the services companies if you're going to be going long oil as well.
Well, the relationship between rising oil, rising cash flow, and rising capex is broken because of guys like me saying, your stock, as a producer, your stock is not guaranteed to go up if you're growing production, but it's almost guaranteed in my mind to go up if you buy back, 25% of your stock outstanding in a single year and tell the street, well, we're going to do it next year, we're going to do it next year, and you force that re-rating. So like everything, generally speaking, looks good. Natural gas stocks even look good with a challenge backdrop. Service stocks look good, but what looks the best? Like, where can I have the highest confidence with my clients' money? And it's investing in companies with low to no debt, decades worth of inventory, trading at a third of their historical multiples, generating the most amount of free cash flow in their history, and pledging to return that back to my clients in the form of very, very big dividends and buybacks.
Sounds like a good setup. Last word to you, and thank you very much for being with us. For those who haven't participated yet in the energy sector, you say what?
The party's just getting going.
Okay, we'll leave it there. Eric, great to see you. Thank you so much, and thank you everybody for watching.